What is a price channel? Welcome back to another trading video. Today, I want to teach you exactly how you can trade price channels with high success. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you. In this comprehensive video, you will learn some of the most effective price channel trading strategies and, more importantly, some critical tips to consider when trading based on these structures. Price channels are wonderful tools for beginners because they provide clear, visual boundaries of where the market is likely to move. Before we get started, please take a moment to give this video a like. And if you haven't subscribed to my channel yet, please subscribe and hit the notification bell so you always get notified of my new educational videos. Alright, let's begin with the absolute foundation. What exactly is a price channel? A price channel forms on your chart when the price action is moving between 2 parallel lines, an upper resistance line and a lower support line. Part 1. The 3 types of price channels. Depending on the direction of the market, we have 3 distinct types of price channels. The first is the horizontal channel, where price moves sideways between flat horizontal lines. The second is the ascending channel, which slopes upwards, indicating that the market is in an overall uptrend. The third is the descending channel, which slopes downwards, showing that the market is in a clear downtrend. Each channel type requires a slightly different approach. When a price channel appears on your chart, there are a few primary strategies we can use to trade them. The first strategy is the trend channel trading strategy. This is the most simple and popular strategy because it is trend following. Here, we take advantage of a trending market. By identifying whether the channel is ascending or descending, we can trade the movements inside the channel to find the best possible positions. Let's break down how this works in an uptrend using an ascending channel. An ascending channel shows us that buyers are driving the market higher, but sellers are still active at the channel ceiling. The lower boundary represents the channel's support line, and the upper boundary represents the channel's resistance line. In this environment, the overall trend is up, which means we want to focus primarily on buy setups to stay aligned with the trend. When the price retraces and reaches the channel's support line, we look to buy or enter a long position. We then hold that trade and take our profit when the price reaches the channel's resistance line at the top. This is where we expect the price to pause or reverse. However, please pay close attention. We never know for sure if the price will bounce or break through the support line. This is why you should never buy blindly just because the price touched the line. Part 2. The confluence and confirmation protocol. Because crossovers and touches can fail, we must always use other technical tools and concepts to confirm our trades. For example, we can monitor volume to measure the actual buying or selling pressure at the boundaries. If the price touches the support line and volume starts to increase on bullish candles, it confirms that buyers are actively entering. We can also analyze candlestick patterns, looking for bullish pin bars or engulfing candles to confirm the reversal. On the other hand, when the channel is sloping downwards, we have a descending channel. This structure indicates that the market is in a clear downtrend, with sellers in control. In this scenario, we do the exact opposite. We only look for sell or short positions. When the price rallies up to the channel's resistance line, we execute a sell trade. We then close our position and take our profit when the price drops to the channel's support line at the bottom. Once again, we do not trade blindly. We look for dynamic resistance confirmation, bearish candlestick patterns, and increasing bearish volume at the channel ceiling before entering our short position. By combining the price channel structure with secondary technical indicators, we ensure that we are trading like professional smart money, not like uneducated retail players who chase price. Part 3. The price channel breakout strategy. The second strategy is the price channel breakout strategy. Here, we take advantage of breakouts. Price cannot stay inside a channel forever. Eventually, it must break out to the top or the bottom. When a breakout happens, it represents a strong shift in market momentum and often leads to massive, explosive moves. However, we must ensure that the breakout is genuine and not a false breakout. To confirm a genuine breakout, the first thing we analyze is the breakout candle. The breakout candle must show significant strength, meaning it must have a large body that closes completely outside of the channel boundaries. Furthermore, this breakout move must coincide with a considerable increase in trading volume. This volume surge proves that institutional buyers or sellers are aggressively backing the breakout. Aggressive traders who have a higher risk tolerance will enter a trade immediately on the close of the breakout candle. However, for beginners and conservative traders, we highly recommend a more secure approach. We wait for a retest of the broken channel boundary. Often, after a breakout, the price will complete a pullback to test the broken level. If the price retests and rejects the boundary, showing it has flipped from resistance to support, we enter our trade. Waiting for the retest and entering only when the market moves back in the breakout direction is how conservative traders protect themselves from false breakouts. False breakouts happen very often on lower time frames due to market noise. By staying patient and waiting for confirmation, you ensure that you do not get caught on the wrong side of the market. Part 4. The horizontal consolidation strategy ranges. The third strategy is the price channel consolidation strategy. In this setup, we specifically take advantage of a horizontal price channel, also commonly known as a trading range. Sideways markets can be highly profitable if you trade them with structure. The unique advantage of a horizontal channel is that you can buy or sell without any fear of trading against a dominant trend, simply because there is no trend. When trading a horizontal range, our strategy is very clean. When the price reaches the channel's support line at the bottom, we wait for bullish rejection and buy. When the price reaches the channel's resistance line at the top, we close our buy position and immediately look to enter a short trade, riding the price back down to support. However, keep in mind that trading inside ranges is generally more risky than trading strong trends. This is because range-bound price action is highly choppy, and you can rarely catch the massive, prolonged moves that are common in trending markets. To manage your risk inside a range, you must always look for secondary confirmations like the stochastics or RSI indicator. If price is at range resistance and the stochastics is showing an overbought crossover, it adds massive confluence to your short setup. Part 5. The non-perfect rule and risk management. Now, let's discuss some critical guidelines for beginners. The most important tip is, do not wait for a perfect setup. In textbook charts, price channels look flawless, with wicks touching the trend lines to the exact pip. But in real, live trading, this rarely happens. You must show flexibility. Sometimes, candles will get very close to the line but not touch it. Other times, candles will pierce slightly outside the channel and then snap back. Always treat price channel lines as zones of support and resistance, not as precise single lines. If you wait for a perfect touch, you will miss most of the best trade opportunities. The final and most important point is risk management. No matter how high probability your setup looks, all trading decisions are based on probabilities, not guarantees. The market can break your channel at any moment. Therefore, you must always use a stop loss on every single trade. For a buy setup, place your stop loss safely below the dynamic support zone. For a short setup, place it above the dynamic resistance zone. By using a strict stop loss and managing your risk properly, you ensure that even when a channel fails, your capital is fully protected. And call to action. I hope this complete price channel breakdown has given you true clarity on how to trade these patterns with confidence. If you enjoyed this video and found it valuable, please take 2 seconds to hit the like button, subscribe to the channel, and comment below with any questions you have. I read every comment to help you. Thank you for watching. Stay disciplined, and I will see you in our next trading video. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you.